Welcome, everyone. Thank you for joining us today, Wednesday. We've got another exciting webinar for you. So, Matt, take it away.
Thank you, Kylie, for putting it all together. Yeah, I've been looking forward to this one for a while now. I get a lot of questions from people all the time about the idea of taking their funds through a broker dealer and having BD raise capital for them. And that it's a big topic, and it's one that I think is widely misunderstood by a lot of private issuers out there who have never done it. They just don't really understand what's what. So, been thinking about it for quite some time to try to get somebody on here. I got introduced to Jarad probably 6, 8 months ago from a mutual business acquaintance, and I started talking to him. I've actually introduced Jarad to a couple of people. We actually haven't done any direct business yet, but I suspect we will here before too long. We find the right client. So really happy to have Jarad Mitchell with us today. Jarad's joining us. He's on vacation with his family in South Dakota today. So thanks for taking some time away, Jarad, and joining us.
Thanks, Matt. Glad to be here. Badlands and Black Hills, South Dakota. Nice to be here. Nice to talk to your audience, and looking forward to the conversation.
Yeah, me too. Me too. So why don't we start by giving us a little bit of background on yourself, and so people familiarize with you, what you've done, and your background. We'll start there and then go from there.
Perfect. Yeah, so I actually went straight out of college, being a wealth advisor for Edward Jones. That was prior to their transition into the RA space. So I started about 23, 24 years old with my Series 7. Went straight out trying to get people to entrust me with their life savings with no gray hair, no experience. It's pretty tough sell. I had a pretty good success, for about 3 to 4 years. However, I saw the evolution transitioning to the RIA sector, which Edward Jones, very large in the Class A shares of mutual funds, didn't really see that they were telling the reps at that point we weren't going down that path. So I ended up going to a smaller RIA based out of Kansas City, kind of a combination of an insurance company and RIA, and helped build some of their business, worked with a lot of qualified plans, things like that. And then in 2013, they started kind of going a different path. So I actually just wanted to take a step back and got into operations management with Scottrade Advisor Services. So that was the Scottrade institutional platform. We custody assets for any number of RIAs, worked with some very large RA firms, I'm sure the audience would know, and a number of smaller ones. In 2017, I believe it was, Scottrade was acquired by TD Ameritrade, so we ended up getting shut down. They had a very well-established team down in Texas and Arizona. So I ended up just taking the severance and went to work for US Bank on the institutional trust and custody side for about a year. That was not for me. So ended up my old team from Scottrade, 3 or 4 of the members ended up with my organization where I reside at currently. So they pushed me hard, talked to the CEO and the owner of the firm, and just seemed to be a good fit. So I've basically been in the alternative side now for about 7 years, and really have just drank from the fire hose just like everybody else, and have looked at everything from any type of private equity deal you can think of. Solar tax equity, something I'm working on right now. We do a lot of private real estate is what we see primarily through our channel.
Yeah.
Private credit, obviously a big hit right now, so that's kind of the flavor of the week, if you will. So really the kind of principal side of the alternatives business, I've been here for about 7 years and still learning more and more every day.
So what do you see as, I know it's a lot of what you describe when I hear a lot of that terminology. I think people in our business who are running private real estate asset-based funds aren't even familiar with some of that terminology, right? So on the institutional side, now coming to the alt side, what do you see as kind of the biggest difference? And as you transition into the world of alts, like what do you see as the difference there, and why do you like alts?
Yeah, so what I will kind of give as my pitch for alternatives. I am a very firm believer. I always liked looking at the portfolios for the endowment funds, Yale, Harvard, and just really seeing how they were outperforming and what they were doing. And right now, if you look at some of those models, they have, probably less than 20%, probably significantly less than 20% in, US or global equities, traded equities. I actually look at the illiquidity of alternatives as a benefit. Just this year alone, we've seen dramatic shifts, market movements and that intraday chatter. Take the tariff date, for example. I was sitting at LAX trying to catch a flight home when Trump announced, I think it was April 2nd, whatever day it was, Trump announced the tariffs. And we just see these 8-9% movements in the S&P, 21 years in this business. And that was, a huge move. I had not seen anything like that since the great financial crisis, which I don't remember quite as well. Yeah, so I look at the illiquidity, removing that intraday chatter and the market movements as a huge benefit. Now, I like the illiquidity aspect of it, but I think a lot of the concerns, the illiquidity, how do investors get out? Buying alternatives in an IRA, RMDs, or, you've got to an inherited IRA from a deceased family member that you take, and you've got to get those assets out. So some of the kind of the downsides I see is how do we get out? So, I know we talked previously, Matt, about the exit strategies. And, from a due diligence perspective, the exit strategy is one of the most important things that I look at, our team looks at from our organization, from a due diligence and compliance perspective.
Well, let's really dig into what I know people care about the most here, which is the idea of, so our clientele would be largely real estate asset-based funds. Many of them are direct ownership of real estate. So these are 506 Reg D funds, almost always. Sometimes you get Reg A funds, but let's call them 506 Reg D funds, investing in direct ownership of real estate or investing in real estate secured loans. Those are the two biggest asset types that we have. And most of these people they've started their own fund, and it's the issuer raising the money on their own behalf. All of whom at some point are looking for ways to expand their ability to raise capital. And all of them at some point say, there's got to be some way that I can find somebody that I can hire to raise capital for me, right? Which of course has all kinds of regulatory issues, because to get paid to raise capital on behalf of somebody else, it has to run through a broker dealer, you have to have licenses, there's all kinds of additional compliance, so on and so forth. So people think about it all the time, but not very many of them are able to go into the BD world and navigate that universe. And so let's talk about, what does that universe look like? Let's say some issuer comes to you, Jarad, and says they want to have your group be the managing broker dealer. And what do they have to do? And we'll get into like what you're looking for, but like just share the process with the audience so they understand what it would take to get on with you guys as a broker dealer, assuming you'd even have them.
Yep, understood. Yeah, I mean, I am a very open and very direct person when it comes to this. I'm a big believer in setting of realistic and reasonable expectations. And I think that's something, your clientele need to be very understanding of. There's a lot of people that do what we do that say, hey, we could easily raise 50 million, $100 million for you. Right now, it's very difficult. So the first thing I tell a new client or somebody that we're prospecting, in talks with, it's going to be painful. It's going to be very difficult. It's going to be very, very expensive. So one of the first stats I like to use, I tell people, it's going to cost you at least just, $100,000, just bare minimum cost of entry to just access the channel. And I mean, that's not success by any means. You're probably looking at really more of a $250,000 budget for kind of the entry point. Almost
so the $100,000 to access the channel, like where does that money go?
Yep.
Like what's that for?
So I kept using, some of those numbers, and it seemed to fall, maybe on deaf ears in certain instances. So I actually kind of put together a budget, line item budget of what that would look like. So obviously most of your issuers should be using, counsel, legal expenses. So that's probably already baked into that. But I will say, as you expand in this channel, the quality of your counsel is going to be very important. So you may go from paying $10,000 or $20,000 for a PPM and an SEC Form D filing to now 40, 60, up to 100 grand or even more for legal services. A lot of broker dealers and even more RIAs now, as they're adopting more alternatives, they want to see certain quality names of legal firms that are vetting these deals. The second step would be, other third-party providers. So a TPA, such as Verivest and other, maybe a transfer agent, SEC transfer agent, but that's always going to have costs and fees built into it. Probably one of the most underutilized or under, I guess, under considered is third-party due diligence. Broker dealers are being very heavily scrutinized in alternatives. Their arbitrations are up, especially as we've seen the shift in interest rates, which is, going back to the real estate business, the shift in interest rates and this debt ceiling, debt rollover that we're seeing is causing a lot of funds to cut their distributions or, cease all distributions in entirety. So a lot of these investors are, filing arbitration, certain civil actions. So what a lot of these broker dealers do is will require a third-party due diligence review. It's companies that have very qualified individuals, attorneys, CPAs, CFAs, just a host of experts that basically will go in and review your offering documents, all your organizational structure and your corporate governing documents, their background checks, financial reviews and the underwriting. And they put together these, that can be anywhere from 30 to 100-page reports that will discuss the pros and cons, risks of the offering, and mitigating factors. As a due diligence person myself, I know that any investment that we're looking at is going to have certain risks associated with it. But what are mitigating factors that we can get comfortable with those risks? The risk reward spectrum, et cetera. Those reports from companies like McLaw, FactRight, Bowman Law, Buttonwood, Snyder Kearney, those reports are going to cost anywhere from $20,000 to $50,000, depending on the complexities of the deal, the number of properties. And then secondarily, most broker dealers almost always now require a sponsor level review. So whoever your issuer's parent, your sponsor that's, Fund 1, Fund 2, Fund 3, et cetera, we want to know the strength of your sponsor entity. We would look at things like capitalization, again, the background checks of the C-suite. Have they filed bankruptcies? Have they, are they adequately capitalized? Marriott, well capitalized. If you're a real estate operating company and you've got, $250,000 of book equity on your balance sheet, are you able to withstand the turmoils and pressures that the industry is going to put on? So again, there's another due diligence report that's another $20,000 to $40,000. So right there,
so there's a deal level report and a sponsor level report. Those are two separate reports. Those could each cost 20, 30, 40 grand each, right? Plus the PPM
Correct.
and all that, which they're going to have anyway. To your point, maybe it's a different lawyer. And then also you have retainers. I mean, then you start getting into this because all you're talking about now is this is just table stakes of entry to even be considered to do it. And then assuming you get approved by the broker dealer, now you've got to pay retainers. Describe that process.
Yeah. So one thing I do want to note, almost every broker dealer that I know, and I mean, I'm a pretty personable guy. I like to, share information with colleagues, keep everybody out of trouble. Knows their chatter you hearing about. Almost every broker dealer firm and a growing number of RA firms that I know require those third-party due diligence reports. So again, that's just the point of entry. So now if you're talking about retainers for distribution capacity, sales is where it gets very expensive. Getting a good wholesale team, somebody that's talking with broker dealer home offices, what we would call a national accounts group. They're going, trying to talk with the due diligence teams, the chief compliance officers. That's their sole goal, is to get a selling agreement with that syndicate member. And then we also have kind of your external and internal wholesalers that are actually calling on the reps of the firm, the advisor of the firm, getting them interested in the program, pros and cons of the program. So from my standpoint, it takes me anywhere from 2 to 4 weeks to review a new sponsor and offering, depending on the complexities. So it takes a lot of resources allocated across our organization to complete that work. If I don't have demand from our rep group as an independent firm, we don't push product per se, but we are getting more aggressive about, hey, we don't want to review this deal. Here's 2 comps that fit what you're looking for, that we vetted, we have a lot of confidence in. But if I don't have demand from the rep group, we spend 2 to 4 weeks of work, at significant cost, in addition to the third-party due diligence reports, because we have our own obligations under both the SEC's rules and FINRA. And, it's really a demand driver. I can't say if we're not selling the product, it's worthless for me to do the work on it. That's just the harsh reality.
Yes. So let's say it's expensive on the front end to get through the DD process to begin with. What are you looking at if you're an issuer? And let's say you did make it through all of that and you were willing to spend the money and you could get through it. What does it cost to pay for retainers and commissions and so forth?
Yep. So at the kind of the direct rep level, so I'm the representative and Matt, I'm selling you real estate fund ABC or private credit fund ABC. I will generally get a selling commission that as a registered rep, Series 7 or other, supporting FINRA registration. And I'm going to get usually anywhere from about 4 to 6%, maybe 7% on the high end. 7% would be probably a real estate development deal, higher risk profile, oil and gas drilling programs. That's definitely on the higher risk spectrum. But generally, I'd say most private placements are about 5 to 6%. Kind of a good rule of thumb is a percent commission for every anticipated year of the hold period. So, if it's a target 5-year turnaround exit, 5% commission for a real estate operating fund, something like that. Additionally, going back to my time and efforts exerted on the due diligence side, most broker dealers or most programs will be built with what we call a marketing or slash due diligence allowance. That's generally going to be anywhere from a point to a point and a half in addition to the selling commission. So let's say it's 1%. That's probably the most common we see in the numbers I usually use when I'm recommending or working on deal structuring. So right there at a 6% selling commission, 1% marketing due diligence fee, that's what gets paid to the selling group broker dealer. The next two fees, there's generally 4 that you'll see in this, what I call the front end load, is a wholesaling fee. If you're hiring wholesalers to go out and distribute your product to the RIA home offices, the broker dealer home offices, the reps themselves, they're usually getting points, either on the front or back end. Generally, it's an upfront wholesale fee that might be 1 to 1.5%. So for simple math here, we'll just keep it at 1%. They're usually, depending on the size of the issuer or the sponsor, they might be broken up into different territories, West Coast, East Coast, Central, however you want to break it down, but another 1% there. And then for Patrick Capital Markets, us as a managing broker dealer, we have to get compensated for our time and effort. I spend an inordinate amount of time working with our sponsors, working on structuring, advising, and consulting. We're kind of an all-in-one menu, if you will. But again, I want to set these expectations with my client, and it takes a lot of time and effort to do so. I can't work for less than 1%. And depending on the complexities and the risks associated with that deal, it might go up from there. And then if you get into some of the retainers, certain wholesale groups, depending on who you're utilizing, some of them will charge a retainer. It could be anywhere from probably $2,500 on the lower end up to $20,000 a month on the higher end. And some of those are used for like T&E budgets, because you got to understand a lot of these reps will, go out to dinners and, get information at conferences, conference attendance. That's expensive. So, and then a lot of managing broker dealers will also charge a retainer.
So if I'm doing the math, Jared, rough back of the envelope math, 6 or 7 plus 1 plus 1 plus 1, you're looking at probably 10.
10, my number.
10% off the top. So if you raise
Yep.
100 grand, you really raise 90.
Yep.
Right.
The issuer is using 90 grand for that program right out of the gate. So if you need 100 to execute your plan, you got to raise
110 or 111. So
111, right.
So theoretically, all of that comes out of the money raised. So you wouldn't have to pay that up front, but my understanding is they want retainers that would, some portion of which would go toward expenses, dinners, travel, et cetera, and some portion of which would be credited toward that 10% on success fee. But if they don't ever achieve any success, then that retainer is gone. Right?
Yeah, so correct. Yeah, the retainer, sometimes it could be structured as kind of a reimbursable retainer. So, if it's a $5,000 monthly retainer, but we had $10,000 worth of fees, it might offset. It depends on the firm and the contract, but some of them are kind of reimbursable or kind of a draw, if you will. Reimbursable draw. But going into your point for like T&E conferences, things like that, most programs will also build in what we call O&O, organizational and offering expenses. That can be used to offset some of those retainers, offset legal costs if it's not a separate line item, conference attendance, which could be anywhere from $5,000 to $20,000 per event, depending on how much you want to spend or how big if you want to give, the legitimacy of the organization. So O&O, it's kind of a catch-all. And I really just personally, going back to the due diligence perspective, I don't like to see O&O over 2% of proceeds, because in essence, it can be used for a lot of things that's really not benefiting the fund nor investors. At the end of the day, as both a managing broker dealer and a compliance principal of this firm, we have to take care of the investors first and foremost. If we take care of the investors, everything else will work out.
So I know for a lot of people in our space, at least, when they hear the kind of numbers that you're talking about, it's just like it's crazy. 10% load right off the top, hundreds of thousands of dollars to even get in there. And for many, it's just not even an option, right? It's the first of all, the math on the fund itself may not even support the load. Right. And second of all, people don't either have the budget or the time or the wherewithal to do all that. So as a result, most of them are issuers that are raising capital for themselves. Right.
Right.
And yet they want to figure out, how do I grow my capacity to raise capital? So therefore they look at this whole broker dealer realm. I know it's a big industry and there's lots of people that do it and are successful doing it. What do you see as being like, what are the types of companies, firms, without naming names, but sizes, characteristics, etc., of people that actually come into that world and have success?
Yeah. So really, I'm going to take it kind of one step further. What I really like to see with sponsors, because at the end of the day, the risk lies on the broker dealer selling that product. The rep might be named, but generally the rep, is not going to have the capitalization to, contribute to arbitrations. They're going to go after the broker dealers a lot more than they will the reps. But so what we look for from kind of a compliance and due diligence perspective is, have you executed on the strategy before? A lot of the broker dealers are not going to be the guinea pig or the test subject to see if your strategy is going to work out. So I think track record is one of the most important aspects of your strategy. Have you done it previously? Have you exited that strategy previously? Have you fully returned capital, and did you do what you said you were going to do? Those strategies, it doesn't have to be a big capital raise per se, but like, doing 2 or 3 funds, friends and family, I think is the great entry point. Maybe a couple $1 million funds that you're able to successfully raise, and under your corporate umbrella, you can actually tag that to, this is my firm's performance. That's going to be huge. I see a number of people all the time that say, come from big sponsor ABC, go out, start their own firm because, hey, we did it here and I got all this expertise. But what they don't have is the backing, the resources, the capitalization that they had at that larger enterprise. So I see a lot of, people break off that might be successful and some that aren't successful at all. So going to answer your question, a $25 million to $50 million deal size as you're kind of gaining traction in this space is, I think, reasonable. A lot of broker dealers aren't going to take the time or effort to look at a $3, $4, $5 million fund. It's just too much work.
It's too small.
Yep, exactly.
Yeah, and there's no way for anybody to justify all those costs for a fund that small anyway. But even 25 or 50 seems pretty small relative to the amount of costs and risks that you're talking about going in. So it seems to me that the groups that are successful in that world that I've seen, and I've been to a number of, the MIC Law and the Fact Right conferences and things where, people are doing what you're talking about. They got to have some amount of infrastructure to be able to justify those costs and to take the risk of all of that, and ultimately to even be able to stand up to the due diligence, right? Because you got to pass muster on all of those on the due diligence, but sponsor level, at the deal level or the fund level, you got to be able to afford to pay all that up front. Then you got to be willing to pay a retainer with no guarantee of success, et cetera.
100%. I mean, Matt, honestly, I tell people, you better be able to take $100,000 bill, $200,000 bill, light it on fire and be okay with watching it burn, because that's the reality. Anybody that guarantees you success, and I'm frankly, I've had some sponsors say, I want you to give me a number, of success, 90%. I can't do it because, the reality is it's such a constantly evolving landscape. It's just something that I cannot confidently give. But
Well, it's highly competitive too, right? It's like there's lots of
that's
there's tons and tons of them that are coming out. If you're a BD,
mhm.
like you can't take on all of them. You can only have so much product that you are. What kind of product in are you seeing that's out there right now is actually selling and people are
Yep.
interested in?
Yeah, great question, because that's one of the issues I see right now. And so kind of timeline in 2021 and into 2022, right before interest rates started going up, money was these deals were flying off the shelf in a lot of cases. A lot of these issuers could sell direct. They had their own audience, from whom they were raising their capital. Once interest rates started creeping up, and I just saw this plethora, this explosion of those, kind of issuer direct, successful, good companies that came to us, needing new channels, needing new, ways to raise their capital, new
Sure.
channels for that capital. And it became very competitive very quickly. I would say the past 2 years since then, so let's say 23 through 25, now you're seeing Wall Street firms, your Blackstones, your Blue
Yeah.
Owls, your Apollo. They are just aggressively coming in and attacking the space where you previously had small to mid-size operators and companies that had very niche programs. You're having the big boys come from Wall Street and really encroach on our territory, and it's affecting our business. Not always positively, but you get some backing from some of the biggest companies in the space and in the sector. I mean, people see Blackstone's name, love them or hate them. People see Blackstone's name on something, and it does give this instant credibility
Exactly.
and
Of
validity to
course.
it. But you've seen these new structures, or newer structures, interval funds, BDCs, tender offer funds that have some of this, I call it, conceptual liquidity, because we all see what happened, saw
Yeah.
what happened with certain REITs, for example, because they took all the headlines. That liquidity, again, going back to my initial comments, illiquidity is a benefit. When you saw those liquidity, thresholds hit, or, certain firms that just shut it down altogether, in my opinion, that was the right move to do. Now, investors didn't like it, but
No,
I
of
didn't
course.
want out of those funds. I wanted them to shut off. That way they weren't having to liquidate those
Yeah.
assets at fire sale prices. That's what these programs are meant to do. So going back to your question, I see this competition really increasing from the big firms and the smaller firms, but I think it is going to drive a better product for the investor, because you're going to have to compete. Where I used to see, a 8 pref and 50/50 thereafter, that's not going to pass anymore. Frankly, from a due diligence perspective, if it's anything that goes beyond 70/30, I'm probably not even going to take the time to look at it, because there's so
Yeah.
many other competitive programs out there. So I
Yeah.
think at the end of the day, going back to taking care of the investor, it's going to drive better competition, lower fee structures, better benefit to the investor, but it's going to come at the cost, to some of these smaller firms as well.
Yeah. So if anybody has any questions, type them in. We'll be happy to try to get to them here. I've got two more questions, and then we're getting to the bottom of the hour, so going to need to go here pretty quick. But a couple more questions for you, Jared. One is, there's fewer broker dealers these days, aren't there? I mean, I know that
Yep.
it's becoming. I mean, this is a kind of an old school business and all that, but it's kind of depleted a bit, right? What do you see the trend in the broker dealer world happening? The level of shrinkage. Where do you see it going in the future?
Yep, great question. We've seen, I can't remember exactly where the current numbers are, but I think we're somewhere around 3,100. It's less and less every year. We do get member reports and we have internal databases for our distribution purposes that we utilize. Broker dealers are, on the decline. The RIA side of the business, however, is expanding. Long term, I could really, that's just purely my thoughts, but I could really see the broker dealer and RIA kind of converging all under one regulatory environment, where the SEC and states really monitor the advisory side, and FINRA is over the broker dealers. I can really see that melding together as
Yeah.
one collective. I think it would make sense, because there's a lot of similar rules and regulations, but they're interpreted differently by different regulatory personnel, and even the
Well,
individuals at the regulators. So I think that's one thing I would see, but I don't see broker dealers expanding going
Well,
forward.
that was my next question. Was registered investment advisors. They're a lot of people in the space who are come from the private world and aren't really familiar with everything you're talking about, sort of conflate broker dealers and RIAs. They just use
Mhm.
them interchangeably, but they're
Right.
completely different things, right?
Yep.
And like the whole economic structure you described earlier, that's not necessarily the case in the RIA world, right?
Correct. So,
Like,
RIAs can't charge. So broker dealer and what we call registered representatives. The broker dealers uh, basically have registered representatives, brokers, primarily that you'll hear the term, that sell for a transaction-based compensation. So 6% selling commission. Registered investment advisors have under their umbrella investment advisor representatives. They cannot receive transaction-based compensation. They bill generally on assets under management. And, sometimes, I'm not going to get into, my thoughts on billing on illiquid assets, which that's kind of a regulatory uh, concept. But, they bill 1%, per annum on their assets that on which they're advising and managing. But if you have strictly like an RAA focused fund, you don't have to build in that 10% load. Now, we will charge a managing broker dealer fee, but we can do a much more efficient cost of capital at that point. So it gives much higher proceeds. Now, there's other ways you can do a share structure or structure your deal where you have kind of RA units and broker dealer units, or you have two different deals for each. I mean, there's a number of ways you can structure it. But at the end of the day, my goal is what can we do for A, most benefit to the investor, and B, the most benefit to the most effective use of the capital provided by the investors to the sponsor and the issuer of those securities. So there's a number of ways you can structure it, and it's probably a whole different conversation than where we're at now, but there are ways to do that.
yeah, I do think that the RIA channel is one that is also widely misunderstood by people, and not very many have been able to really penetrate that channel, but that's probably a more viable channel from a cost perspective for a lot of these
Yep.
funds. But it's a completely different ballgame in terms of like how you go out and structure that and how you sell it, how you market it, et cetera. Right. And I mean, then we don't have time for all of that today, but I think the main message to people today is the idea that broker dealer, RIA, two different things.
Very much. So the broker dealer, while it is segmented and everybody has their own written supervisory procedures, what we have to do to check all the boxes, I would say the RIA channel is extremely more segmented. Every firm does it differently. Everybody wants, access that fund to be on Schwab or Pershing, wherever they custody their assets, wherever they hold their assets, so that they can have it all in one consolidated statement. So there's a whole different demand and need for the RIA side of the business as opposed to the broker dealer. So really, if your clients, your sponsors are working with a firm, they need to make sure that they understand all the mechanics and the deal structure, the players, the distribution networks, the distribution partners, wholesalers. There's just so much. And I've seen a number of my competitors in the broker dealer world that are, just a SEC registered and FINRA regulated broker dealer, and then they just slap on, oh yeah, we also do managing broker dealer work. It's two different, retail broker dealer versus managing broker dealer work. It's two very different business lines, and you have a very, very different level of expertise and demand for what you need to be able to accomplish through those two networks. Now, we do have under our corporate umbrella, we have a retail broker dealer, totally segmented and separated from Patrick Capital Markets, along with an SEC registered investment advisor. So I'm affiliated and registered with all three of our firms. So I see, from start to finish, the process inside and out. So I think that gives us a very good competitive edge against a lot of our other, competitors out there.
Yeah, well, Jarad, appreciate you showing up, man, especially on vacation. I know that you scheduled this before you had scheduled the vacation, so I appreciate you honoring your commitment, even while you're enjoying the countryside out there in South Dakota. I think for all the listeners out there, I mean, kind of the main message is, and I say this all the time to people, is like the broker dealer channel really is not viable for majority of, especially relatively small managers that are kind of just getting started or trying to raise capital. It's too expensive and it's too cumbersome, and so you got to really have some size and some heft to even make it be close to making sense. Jarad's a wealth of knowledge on this front, and I appreciate you being here, Jarad. Thanks so much.
Yeah,
and
and
your
and Matt, I
vacation.
did see a question. Maybe I should have been looking at that a little bit more. And I saw your response to the question there about competitive advantage for broker dealers and small fund managers, expensive and cumbersome. And I agree. But I think what you can get is some very good insight and advisory consulting that can help you determine the right path and how to best utilize those proceeds that are coming in and give you the most effective cost of capital for that. So yes, it is expensive just solely focusing on the broker dealer side, but it's so much more than that. You really, I had somebody that basically said, well, you're a service provider, you should do this. If you're looking at me as a service provider, I'm not the right guy for you. We're not the right shop for you. We are partners in this. We live together, we die together. We want to be successful together. So I think the partnership and that advisory and consulting is where the benefit truly is going to come. And Matt, you and I have had how many conversations over the past 6 to 8 months, that we've known each other, and we know the complexities that exist in this marketplace. And it's only continuing to evolve. So the next steps, and maybe webinar, part 2 later on down the road is where does it going from here? Because I think it's a hybrid of not just the program structures and your RA, broker dealer, share classes and all that, but also a hybrid distribution structure. And that's something that, I'm trying to get ahead of, because if you're not thinking, 2 miles down the road, you're going to be left in the dust.
Yeah, I think it's a good point that there's a lot of things you can learn from the whole arena in terms of like what things that you can do, even if you don't go through the BD channel, to just become more institutional looking in terms of like how you get your due diligence and all that stuff that good managers make it a point to do anyway, no
Yep.
matter whether they're trying to go the institutional realm or trying to go through broker dealer channel or RIA channel or whatever. So I just think at the end of the day, trying to go through that channel and raise capital, it's a tough slog. It can be done. I've seen some people be successful at it, but it's very much a minority. So Jarad, appreciate you being here. So thanks everybody for joining us. Join us in September. We've got Alexi from CEO of GPLP Match. You might see him on LinkedIn. We've done a little bit of back and forth with Alexi. He's got a fascinating model trying to help sponsors connect with LPs, both for syndications and funds. And he's going to join us here in September. Jarad, thanks for being here. Appreciate it while you're on vacation. Everybody, thanks for joining us, and we'll see you in September.
Thanks, Matt. Good to see you guys. Take care.